I've been joined by Thomas Buess, CFO for SwissLife, and welcome to Berenberg's European Conference here at Penny Hill Park. Let's start with cost cutting, something you've been focusing very hard on for a few years now and successfully. Is that going to continue?
Yeah, actually, it's going to continue. Actually, we have already cut out about 400 million in the last 3 years. And we have announced last year that we will cut out another 130 to 160 million. And we are well underway already in doing that. We have so far already implemented about 50% of the cost-cutting initiatives. And I think there is no doubt about us meeting the target that we have announced.
Growth has been helped by the SME demand for full insurance solutions. Is that sustainable?
I think so, yes. I think, when you look at the three factors that really are driving the growth, that the three factors will actually persist. The first factor is clearly the economic growth in Switzerland, which this year and last year was quite strong, accompanied by immigration, and therefore the labor force or the employee force has grown substantially in Switzerland. This, of course, has fueled the demand for the second pillar solution. The second factor that drives this is clearly that this system has not yet reached its steady state. There's still a lot of people that have not yet been within the system for their entire work life, and therefore there's a catch-up taking place, and this will continue for another, I would say, 10 to 15 years. And then the last factor, which I think is also really important, is clearly that the small and medium enterprises are flee back to safety, to safe haven, because we guarantee them, the 1.5% interest rate, which they don't get when they stay in an independent or in a semi-autonomous pension fund. So they cannot get into undercoverage, which has happened in the past. That's why they're coming back now to the full insurance solution.
If I switch to investment returns, you've been very good at your timing, switching between funds. Mm-hmm. Is that good judgment or good fortune?
No, actually, it was a pure risk-return rationale. We have looked at the Eurozone. Our view was that the Eurozone is, in danger of being either broken up, or that there will be at least a mutualization of the debt within the Eurozone. And that's why we have moved out of the Euro and moved into Swiss franc. And by doing that, we have realized substantial gains. These gains, however, have been used to strengthen our reserves, in line with the low interest rate environment. So actually, we have supported and we have strengthened the balance sheet for the future.
Very, very quickly, your payout ratios are somewhat lower than peers. Is that going to change soon?
Not soon, but we have announced that it will take another 2 to 3 years for us to build up a buffer for the Swiss solvency test. This is also well underway, given our very attractive earnings power. I expect that we may reconsider the payout ratio in 2015.
Thank you for joining us here at Penny Hill Park.
Thank you very much.